Hello, and welcome to our first quarter Market Insights video. Clearly, this has been an extremely unusual quarter and a difficult one for investors and market participants, as the outbreak of the coronavirus has created significant stress on global economies and capital markets. What we would like to do in this video today is share our thoughts and analysis on not only what has happened, but what we can expect out of economies and markets as we go forward through the rest of the year. As a way of introduction, my name is Greg Leonberger. I'm the Director of Research here at Marquette Associates. The agenda will follow typical agendas that we have on these video series. We'll begin by talking about the U.S. economy, since that's the natural backdrop to the capital markets we will discuss. We'll move on then to the traditional asset class of today's session, talking about fixed income, led by Ben Moore, U.S. equities, which will be covered by Samantha Grant, and then non-U.S. equities, which will be led by David Hernandez. We'll then move on to the alternative asset class section of the video. Joe McGuane will discuss hedge funds, Jeremy Zirin will discuss both real estate and infrastructure, Derek Schmidt will cover private equity, and Brett Graffey will cover private credit. If you have any questions, we have contact information for each presenter included in each new section starter of the video, as well as at the end of this video, we have a couple of different contact pieces for people who like to reach out and ask us questions. We'll start this session by talking about the U.S. economy. We're going to investigate what the coronavirus and the outbreak of the coronavirus has done to the U.S. economy, as well as the global economy. We'll talk about job losses, we'll talk about a likely recession, and we'll also talk about what to expect going forward in the coming quarters. In terms of trying to assess the economic impact of the coronavirus outbreak in the United States, there are literally thousands of data points we could share. We are trying to hit the highlights with this slide here. In terms of infections, there have been more than 2 million infections across the world with the coronavirus and more than 600,000 in the United States. As a result of this, we saw the bull market of the S&P 500 officially enter bear market territory in March. First quarter GDP is likely to be negative, and second quarter GDP is going to be especially negative. In terms of unemployment, we have seen more than 16.8 million people file for unemployment in the last 3 weeks alone. The April unemployment number is expected to be the worst on record. Furthermore, there's been an oil war price between Russia and Saudi Arabia, and that has driven the price of oil down. That has also contributed to market volatility. In response to all this, the United States has enacted fiscal and monetary policies to fight the recession and market volatility. The Fed has lowered rates to 0%, and the U.S. government has issued a $2 trillion stimulus package to help bolster the economy. There are a couple of slides in the U.S. economy section which will illustrate the impact of COVID-19 on the labor market. This is a relatively high-level slide put together by Bain Capital, in which the colors are relatively intuitive. Anything in red here illustrates a percentage of workers that have been negatively affected by the coronavirus outbreak. If you add these three slices together for those who have seen their income or hours reduced, or have been temporarily or permanently laid off, or have temporarily or permanently closed their business, that is almost 60%, with another 35% who have not been impacted, at least at the time of this survey. This speaks to the fact that a majority of workers have been negatively impacted, creating further headwinds for the U.S. economy. The impact of the coronavirus on economic growth will be felt without a doubt in the second quarter, and many have speculated that we are already in a recession as of the end of the first quarter. Shown in this slide is survey data from a number of different large banks in the United States. As you can see, there are many indications which suggest that first quarter growth was negative, and second quarter growth will be painfully negative. Also worth noting are the positive numbers for third and fourth quarter. The expectation is that when the economy does open up, consumers are able to go back and shop, employees are able to go back to their jobs, the economy should snap back relatively quickly, and that is reflected in the third and fourth quarter GDP growth numbers on this chart. We wanted to look at the change in economic activity on a real-time basis for the United States. We've done that in two different ways on this chart and the next chart. This chart looks at the change in restaurant reservations on the website OpenTable on a year-over-year basis. You can see the dramatic fall off as shelter-in-place edicts started to take place over the course of March. Of course, this translates to lower economic growth because less people are working, less people are spending money, and therefore there is less money going through the United States economy. Another way with which to look at the stop in United States economic activity is by air travel and the volume of air travel. What we've shown here is the throughput on a daily basis as measured by the TSA here in the United States. Both last year as shown in the gray and this year as shown in the blue. Again, the pattern is similar to what we saw on the previous page. Air travel virtually fell off a cliff. Airlines are hurting right now and requiring United States money from the government to help survive in the face of this recession. Last, we look at different sectors of the United States economy and the change of growth from quarter over quarter. Not surprisingly, the service sector in the United States, such as air travel, recreational services, restaurants, hotels, and durable goods, saw a substantial drop-off in the first quarter. Again, all this translating to much lower economic growth and the fact that we are already in a recessionary environment here in the United States.
Hi, I'm Ben Moore, Marquette's Director of Fixed Income. So far in 2020, the coronavirus pandemic has led to a cash dash that introduced tremendous value in bonds. The spiking new infections and the economic fallout from the shelter-in-place policies widened spreads, and the flight to cash steepened the yield curve. The AG is up 4% so far, and long government bonds are up 21.3%, as overall yields have declined. High yield is down 9.9%, and bank loans are down 10.2%. Emerging markets debt is down 12%. After a bout of spread widening from a crisis, fixed income asset classes tend to subsequently perform very well over time. We can see here that in the top table, the quarter going into a crisis may be challenged, with plus sectors such as bank loans, high yield, and emerging markets debt sustaining losses. But in the bottom table, as spreads tighten back in, coming out of a crisis, the plus sectors perform very well. High yield, for example, was up 58% in 2009 as shown. The key is to stay invested and be there for the rebound. How is this crisis like 2008? Similar to the housing crisis, all ratings quality segments initially fell in lockstep, with dispersion later realized as investors tilted up in quality. Here we could see in both charts that CCC bonds remained down, while BB bonds rebounded. There will be clear winners and losers through this pandemic. During this crisis, energy, gaming, leisure, and aerospace are the worst hits so far, with food and drug, utility, and technology holding up the best. To get a sense of how different these industries are, going into 2020, Google had a coverage ratio of 300 times. In other words, its cash flow was 300 times greater than its interest expenses. On the other hand, Boeing had a coverage ratio of negative 2.4 times. That is to say, its cash flow was negative 2.4 times its interest expenses. During the 2008 housing crisis, financial services were hit the worst, but rallied the most by the end of 2009. Governments from around the world have initiated unprecedented stimulus to support the markets and economies. Here in the U.S., we passed 3 phases of relief stimulus that includes over $2 trillion in loans and grants to distressed businesses, as well as checks to households. And the Federal Reserve has cut rates to 0, as well as embarked on unlimited purchases of Treasury, MBS, investment-grade corporate, municipal, and just announced last week, high-yield corporate bonds. Overseas, other governments have begun asset purchases, cut interest rates, and also launched stimulus packages. In this table, we see that the Fed has taken roughly the same amount of action in this crisis versus the housing crisis, ranging from the zero interest rate policy to quantitative easing to facilities to backstop the markets. 10-year and 30-year Treasury yields are roughly at all-time lows, with the yield curve still positively sloped because of the Fed's zero-rate policy and the recent cash dash as investors sold both stocks and bonds to raise cash. The spread widening has introduced strong value for bank loans, high yield, and emerging markets debt. Spreads for these plus sectors are now attractive and will not remain at these attractive levels forever. We recommend rebalancing to long-term strategic allocations to take advantage of these strong yields and wide spreads. Fallen angels, bonds downgraded from investment grade to sub-investment grade, have hit a record high $100 billion year to date, with another $100 billion plus expected in the rest of 2020. An important dynamic that bears paying close attention to is that during a crisis such as the 2008 housing crisis, spreads peaked and began tightening well before peak defaults were reached. In other words, spread tightening leads defaults, or defaults trail spread tightening after crises, as shown here. As such, we recommend staying invested so as not to miss the rebound in bank loan and high yield bond prices before defaults, downgrades, and bankruptcies ramp up in the coming months. As we saw going from 2008 to 2009, spreads peaked in late 2008 and began tightening in earnest from that point forward. Even as defaults, downgrades, and bankruptcies mounted in 2009, spreads continued to tighten throughout the year for the overall bank loan and high yield markets, which translated to positive returns despite the defaults and bankruptcies. Based on current spreads and worst-case 2009 recoveries, default rates in the low teens for bank loan and high yield are implied. Distress is now at tech crisis levels and has spread to all sectors, led by energy, MLPs, and gaming. Liquidity was strained but has improved for both investment grade and high yield after the Fed began buying investment grade and high yield corporate bonds. Outflows began in earnest across all fixed income asset classes starting in March, but high yield has seen small inflows lately as some investors average in given the attractive spreads. As we brace ourselves for the recession that is to come, one silver lining is that banks are much stronger this time. As these two charts show, bank balance sheets were exceptionally strong with very high Tier 1 capital ratios going into the coronavirus crisis. Corporate debt is currently less of a concern compared with consumer debt. As a share of GDP, corporate debt is a lot smaller versus household debt. Moreover, consumer debt is much lower than it was going into the 2008 housing crisis. This should help provide some upward support for both the economy and the markets as we sustain the oncoming recession. The muni treasury ratio rose further above the long-term average of 0.8, signifying that muni yields are still more attractive than taxable yields for high net worth investors. For final fixed income takeaways, we want to emphasize that spreads can't remain at these attractive levels forever. We recommend averaging into plus sectors for the remainder of the year to be there for the rebound. For core bonds, the yield curve is near record lows and upward sloped due to the cash dash that pushed ultra-short security prices up and yields down. We have had a record $100 billion of fallen angels year to date, with another $100 billion expected for the rest of 2020. For bank loans and high yield, spreads spiked in March and now are still showing tremendous value in April. Defaults are just starting to rise, but in the 2008 housing crisis, spread tightening started much earlier than default peaks. For emerging markets debt, spreads are near all-time widths and showing exceptional value, and the muni treasury ratio remains high, showing continued attractiveness in municipal versus taxable bonds for high net worth investors.
Hi, I am Samantha Grant, and I will review U.S. equities. The longest bull market and economic expansion ever is most likely over. However, it will not be official until the National Bureau of Economic Research declares an official recession later this year. The S&P 500 peaked February 19th before declining into bear market territory, defined as a drop of at least 20% by mid-March. At its lowest point on March 23rd, the S&P 500 was down 34% and was trading at its 2016 levels. However, the beginnings of a rebound took hold for the remainder of March. The index ended the quarter down 19.6%. Even though domestic equities are in a bear market, longer-term returns are still favorable at a 10% annualized rate over the past 10 years. Over the quarter, investors wanted one thing: safety. They found safety in large cap stocks, which outperformed their small cap peers by 10%, and growth stocks, which outperformed value peers by 13%. All 11 sectors declined in both February and March. Surprisingly, technology was a defensive sector in the downturn, along with the usual suspects of healthcare and consumer staples. Energy was the worst performing sector, down 50%, as Saudi Arabia and Russia engaged in an oil price war, while financials, down 32%, declined on lower interest rates. As a result, the coronavirus pandemic exacerbated the performance spread between growth and value. The sharp underperformance in cyclical sectors, which also happen to be the value-heavy sectors of energy, financials, industrials, and materials, widened growth versus value spreads, two extremes not seen since the tech crash. Here, we show the last two bear markets, the dot-com bubble and the global financial crisis, which are shaded in gray. Notice that after the dot-com bubble, the market regime changed from growth to value, and then after the GFC, the market regime changed from value to growth. Only time will tell if this bear market is a harbinger for change in market leadership. In last quarter's webinar, I remarked on how high equity valuations were. Outside of small cap stocks, large and mid cap stocks were valued in the top 10 to 20% of their 25-year range. However, fundamentals looked increasingly supportive due to a de-escalation of the trade war, among other things. Now, the S&P 500 trades at approximately 16 times earnings, which is around the historical average. We believe equity valuations will increase in the near term, given the lower earnings expectations and the recent rebound in equities through mid-April. But let's pause to examine bear markets and highlight a few facts. Going back to 1950, the average peak to trough bear market was negative 35.8%. The current bear market's most recent bottom was approximately 34%, so near the average. However, bear markets range from being as tepid as negative 21.6% to severe like the negative 56.8% during the global financial crisis. Most equity bull markets take around 9 months to become a bear market, whereas the current bear took about 3 weeks, the fastest ever. Lastly, on the positive side, once the trough is reached, the rebound can be strong. On average, equity markets rebound by 40% in the year post-trough. But how secure is the recent rebound? It is not unusual to have several counter-trend rallies within a broader decline. In the top chart during the global financial crisis, there were 5 periods of 10% plus rallies before the market bottom on March 9, 2009. In the aftermath of the tech bubble bursting in the bottom chart, there were 3 such rallies, and so on and so on. As a result, we will be monitoring the coronavirus infection and recovery rates for clues as to when we can officially declare a market bottom. One of the things that may precipitate a potential new bottom or continued highs are earnings. To be clear, no one knows what earnings will look like for the rest of the first quarter, or the year that is. There is no precedent for the closure of the U.S. economy. As a result, companies have retracted their full-year guidance, and the SEC has asked management teams to focus on, quote, where the company stands today, operationally and financially, and how its condition may change as efforts to fight COVID-19 progress. At the start of the year, analysts expected earnings growth in the 6 to 10% range for 2020. Analysts now expect first quarter 2020 earnings to decline by 9.1%. This is only the 8th largest decline in earnings estimates and pales in comparison to the 30+% declines seen during the global financial crisis. 65% of the S&P 500's market cap reports earnings in the last half of April. If earnings were to come in below consensus, the recent recovery may falter. Moving on to valuations, at the end of the year, the S&P 500 was trading at 19.8 times forward earnings, so pretty expensive. As a result, the outlook for future equity returns was moderate. On the other hand, small cap stocks were trading at 16.1 times forward earnings and in the lowest 25% of their history. Currently, the valuations for both large and small cap equities have compressed, and both, especially small cap stocks, look attractive on a valuation basis. For instance, when the S&P 500 is trading at 16 times forward PE, the subsequent five-year returns for the index have ranged between -2% and +19%. The Russell 2000, not pictured here, shows similar positive returns over the subsequent 5-year period. Overall, the risk-off environment has made domestic equities quite attractive. Here we show the additional return available to equity investors above the 10-year Treasury yield. With the Fed's decision to reduce interest rates to essentially zero, equities look advantageous relative to bonds. The equity risk premium is trading at levels not seen since the U.S. debt downgrade in 2011. Equities are often a leading indicator for the economic environment. The economy has descended into bear market territory in a little over 3 weeks. However, bear markets and recessions do not last forever, and at the end of each is a new bull market or economic expansion. As we navigate these volatile times, we expect defensive sectors like consumer staples and healthcare, as well as defensive factors like low volatility and quality to perform well. But we are also looking for signs of an early bull market where more cyclical sectors like consumer discretionary and industrials and cyclical factors like size and value should outperform. That said, we may already be in the midst of a nascent recovery. Since the market bottom on March 23rd, mid-cap stocks and value stocks have outperformed their large cap and growth peers. For instance, the S&P 500, which has had middling performance since the bottom, has rallied 25% through April 10th. However, the index still trades 18% below its all-time high on February 19th. Looking forward, we expect volatility to remain elevated as investors try to gauge the path of COVID-19 infections, recoveries, as well as corporate earnings. Once we have more clarity around the economic growth situation, the rebound in equities should have more stable footing to start the next bull market. As a result, we are monitoring the market for signs of a change in market leadership to the potential benefits of areas that have been beaten up, like small caps and value.
My name is David Hernandez, and I'm going to cover the non-U.S. equity section. The first quarter of 2020 was unprecedented. At the start of the year, investors had high hopes on the back of a U.S.-China trade deal and accommodative monetary policy throughout much of the world. Equity returns were strong in 2019, upwards of 15% for most broad benchmarks. Markets started off the year with the positive returns, but that quickly changed in January for non-U.S. equity markets. COVID-19 began to spread in China, and emerging market equities ended January down 4.7%. In contrast, the S&P 500 moved higher and wouldn't start its downturn until mid-February. Non-U.S. equity benchmarks peaked on January 17th, and the MSCI EAFE and MSCI EM indices lost 23 and 24% respectively in the first quarter. To put some context to these dramatic losses, we looked at previous bear markets for the MSCI EAFE and MSCI EM indices. We defined bear market as a 20% decline from a peak index reading. For the MSCI EAFE index, we have seen 8 bear markets the last 50 years. For those bear markets, the average drawdown is 36%. The current drawdown for the MSCI EAFE is 34%, and that's from the January 17th peak to the most recent trough, which is March 23rd. Now, on average, if we look at these historical bear markets, the one-year forward return from the bottom is 40.7%, and the average two-year return from the bottom is 66.3%. For the MSCI EM index, which has a shorter history, there have been 4 bear markets in the last 30 years. Looking at those bear markets, the average drawdown is 46%. The current drawdown from the current trough on March 23rd is 34%. Looking at these bear markets, the average one-year return from the bottom is 77%, and the average two-year return from the bottom is 93%. So I think the takeaway here is that while returns in bear markets are certainly painful, historically, these types of drawdowns have been followed by strong returns the following year, and this has especially been the case for emerging markets. In the first quarter, an important phenomenon to review is the wide divergence in country returns. The standout here is obviously China, which was down 10%, while the U.S. and most European countries were down 20+%. A key reason why China outperformed is because the country is farther ahead in navigating through the coronavirus crisis. At the end of January, China trailed the S&P 500 by 5%. At this point, China's economy was at a virtual standstill as people were ordered to stay at home, and this was during the New Year celebration for China. At this time, the number of daily new cases of the virus in China was accelerating. But thanks to some very strict measures taken, they began to show signs of slowing in mid-February. And by the end of February, China was outperforming the S&P 500. The end of February, Europe and the US were still in the early stages of navigating through this pandemic, and the number of daily new cases in these regions were still growing. When we look at the economic data, we also see signs that China is ahead in terms of navigating through this crisis. In February, China's composite PMI fell from 51.5 in January to 27.5 in February, and this was an all-time low. The US and Europe, not yet impacted by the spread of the virus, had a February reading of 49.6 and 51.6 respectively. In March, however, the US and Eurozone both fell, while China's PMI spiked to 46.7. I think there are two key takeaways here. One, hitting a peak in the number of daily new cases is an important milestone on the road to recovery. And two, China is farther ahead of the process and can serve as a future indicator for the US as well as Europe. In response to the COVID-19 crisis, central banks and governments throughout the world have taken aggressive action. Several emerging and developed countries cut their key interest rates in the first quarter. The Bank of Canada and the Fed were most aggressive, cutting by 1.5%. The European Central Bank didn't cut their key interest rate, but they did institute aggressive loan programs as well as increase the amount of bond purchases. Additionally, several countries in Europe launched large fiscal spending packages. Germany, normally a very fiscally conservative country, announced an $810 billion stimulus package to combat the epidemic. This country hasn't issued new debt since 2013, and the dollar amount represents just over 20% of the country's GDP. The US has also been aggressive, launching a $2+ trillion package, which is roughly 10% of the US's GDP. So in response to this unprecedented shock to the global economy, we've seen central bank stimulus through rate cuts, bond purchases, as well as loan programs, and that has been coupled with fiscal stimulus from several countries throughout the world. So far, markets have responded positively. From the March 23rd lows, we've seen double-digit returns through April 10th for most broad equity benchmarks. Now, during this short period of time, we've seen a change in leadership, with the S&P 500 returning 24.8% and China returning 12.2%. The MSCI EAFE and EM indices are up 19.3% and 17.3% respectively. I think it's important to note that historically in bear markets, we see strong moves up before ultimately hitting a new bottom. So these last 2.5 weeks do not necessarily mean that March 23rd will stay as the bottom date in this bear market. However, this bear market is unprecedented in terms of how quickly and how sharply these losses came, so a quick recovery is possible. An important item to track is any possible second waves of COVID-19 cases that we may see in different regions throughout the world. I think a second important note to make is that equity markets are usually forward-looking. The market generally recovers before economic data and company fundamentals. Said another way, we usually see a market bottom, equity market bottom, before we see a bottom in economic data as well as company earnings. So looking forward the next couple of months, we're going to see some tough numbers. For example, earnings growth in 2020 is expected to be negative for most broad benchmarks. This is a dramatic change from last year when analysts expected double-digit earnings growth for 2020. Let's wrap things up with the takeaways for non-U.S. equities. It was an infamous quarter for equities as COVID-19 spread and caused economies to shut down throughout the world. Equities were the first to fall, and we've seen and will see further deterioration in economic and earnings data in the coming months and quarters. Equity markets tend to be forward-looking, so it's likely we'll see a rebound in stocks before we see a full economic recovery. China, being farther along in that recovery process, may provide an example for things to come. Central banks and governments have taken aggressive actions to support economies and markets throughout the world.
Hello everyone, I'm Joe McGuane and I'll be covering the hedge fund section today. Hedge funds finished the quarter sharply lower as the widening coronavirus pandemic drove steep equity market declines, sharp spread widening, and an expected slowing global economy and high unemployment. Event-driven suffered the worst loss in March as arbitrage spreads widened due to forced selling by hedge funds during the month. Equity hedge strategies suffered a steep decline during the month but outperformed the broader market indices as short alpha offset some of the losses on the long side. Macro strategies were the lone positive strategy for the month as gains came from long and short positions across fixed income, equity, currencies, and energy commodities. This chart compares the daily moves of the S&P 500 to the HFRX Global Hedge Fund Index through the first quarter. The S&P 500 began to drop precipitously after its peak on February 19th. While hedge funds were not immune to market correction, as a group they held up better and were less volatile day to day than the broader market. This chart breaks down the companies in the S&P 500 index by quintiles from highest to lowest short interest. The left side of the chart shows the top 100 companies with the highest short interest during the first quarter. Shorting provided strong alpha during the month to offset some of the long performance. Shorts in lodging, gaming, airlines, and leisure sector were the most profitable sectors during the month. U.S. long-short gross leverage in Q1 peaked at 200% in January, before falling with the market to a low of 163%. Net leverage peaked at 51% before the market's downturn and bottomed at 36%. This chart shows how defensive hedge funds got during the month of March. This chart shows the performance of Goldman's portfolio of favorite hedge fund picks, which draws from over 800 hedge funds. The popular holdings in hedge funds were positively correlated with growth and momentum, which performed in line with the S&P 500 during the volatile month of March. The 50 stocks in this index are heavily weighted towards infotech, consumer discretionary, and communication services. This chart shows the price action of the VIX index compared to the at-the-money put option premiums on the S&P 500. On March 16th, the VIX hit an all-time high of 80, causing the 30-day at-the-money put options to sell for an 8% premium. An 8% premium means the S&P 500 could go down by as much as 8% and not lose the premium sold on those options. Volatility risk premium managers were selling options at the highest premiums they have seen since the inception of those strategies during the month of March. The following chart shows the percentage of loans in CLOs trading below $80, a key metric for stressed loans. As of the end of March, 30% of loans in CLOs were trading below $80. Given the current economic condition, managers expect to see an uptick in stressed and distressed loans moving forward. Looking back to the global financial crisis, hedge funds, as measured by the HFRI Composite Index, outperformed the S&P 500 by a fairly wide margin over the 4.5-year period of above-average volatility. While the market bottomed on March 9, 2009, volatility remained elevated for another almost 3 years. Today, though the market has rallied off its March 23rd low, VIX remains quite high. As history has shown, the flexibility afforded to hedge fund managers can be beneficial in times like these. And finally, hedge funds struggled in March, though held up better than broader market indices. Funds were first observed actively degrossing during the week of March 16th. Average net leverage across strategies was reduced, but never got as low as in past market sell-offs, and currently sits near its long-term average. Tech, media, telecom-related industries saw exposure reach recent highs as the most net bought group in March. In a more volatile environment, the flexibility afforded to hedge fund managers can help generate relative outperformance.
Moving on to real estate, I'm Jeremy Zirin, Senior Real Assets Analyst. Preliminary private core real estate equity returns based on the NFI Odyssey have been released, with a positive 1% total return for the first quarter. This compares favorably to public REITs, which were down more than 23% in the first quarter. The first round of appraisals were mostly completed prior to the coronavirus pandemic. However, further complicating matters, the lack of transaction volume, comparable sales, leases, and loan originations, which collectively have made it extremely difficult for appraisals to adjust valuations at this point in time. As a result, real estate appraisals were mixed for the first quarter. However, we would expect to see write-downs in the next several quarters, particularly as more information becomes available. While the private real estate market haven't yet been fully impacted by the pandemic, public real estate has. This chart looks at the various REIT subsectors and the impact on performance from February 21st through March 31st. You can see that malls and hotels were hit the hardest, while sectors such as self-storage, life science, and industrial were most resilient. These sectors continue to benefit from the secular tailwinds, whereas regional malls and hotels are likely to experience additional pain until the dust settles. Beyond the troubled sectors mentioned in the previous slide, the impacts from COVID-19 will ultimately vary by property type, geography, and risk profile. This table highlights the potential near-term and long-term impacts for each property sector. For example, looking at retail, in the near term, public shopping venues, particularly restaurants and malls and popular tourist destinations, are likely to see reduced foot traffic, thus further exacerbating ongoing challenges for brick-and-mortar retail. The impact on consumption is of greater concern if consumer confidence weakens materially from current high levels. In the long term, disruptions may accelerate e-commerce adoptions, particularly among the elderly, who might have been reluctant to shop online before the virus outbreak. Apartments, on the other hand, should be most insulated from the fallout, but will face increasing risks if the outbreak extends longer than expected and employers begin laying off workers. Despite all the negative headlines in the news about landlords seeing significant rent relief requests, cash collections for April have actually been relatively high for the most part for commercially owned apartments. However, we believe there are bigger risks on the current development projects, with the potential for state or local governments shutting down construction and the ability for inspectors to approve work that has already been done. From a diversification standpoint, exposure to sectors most impacted by the pandemic, such as retail, hotels, senior housing, and student housing, represent a relatively small portion within the NFI Odyssey Index. This should hopefully help insulate returns from severe write-downs and negative returns in the coming quarters as things continue to unwind. In terms of longer-term performance expectations coming out of the market downturn, this examines forward-looking returns for private real estate based on historical cap rates of the NCREIF Odyssey Index, which is a proxy for core private real estate, and the spread to the 10-year Treasury yield. Real estate valuations based on spread to treasuries are currently above 300 basis points as a result of COVID-19. Spreads of this magnitude have only been seen 4 times, each of which is followed by impressive 3 to 5 year returns. For example, during the Great Financial Crisis, real estate spreads to treasuries surpassed 300 basis points in the fourth quarter of 2009, which were followed by 12.2% and 12.4% returns for the NFI Odyssey Index in the subsequent 3 and 5 year periods, respectively. U.S. real estate has historically provided a degree of shelter from severe shocks. This table illustrates private real estate performance based on the NPI during historical exogenous shocks compared to the S&P 500 and publicly traded REITs. During the Great Financial Crisis from December 2007 to June 2009, private real estate observed a total return of negative 12.2%, but delivered a 13.1% return for the subsequent 12-month period. Private real estate returns are predominantly driven by income from contractual leases and changes in property capital values, which helps insulate the asset class from public market volatility and, to a lesser extent, sluggish economic growth. However, the shuttering of the U.S. economy in response to the coronavirus outbreak has created the very real possibility that significant rent payments will not be made, which may lead to losses for real estate funds until the economy can reopen once the pandemic has been contained. Longer term, we expect a recovery to take hold, but the impact of private real estate over the next few quarters rests largely on how quickly economic activity resumes and the extent to which rent payments are not made by building tenants. Of particular concern are the sectors with substantial exposures to travel and retail, since people are mostly confined to their homes, as most states have issued shelter-in-place orders. Due to the lag nature of real estate returns, the impacts will trail the equity and bond markets, and when those markets begin to recover, real estate will likely trail, similar to past crises, such as the Great Financial Crisis. Although short-term performance challenges loom, the longer-term thesis for private real estate remains, and it should continue to be a accretive component to portfolios for which from both a diversification and return perspective. Moving on to infrastructure. Despite the market downturn, there is still trillions of dollars needed for infrastructure investments globally, which continues to drive demand for the asset class. However, infrastructure is not completely immune to the global pandemic, and certain subsectors have already been more impacted than others. For example, GDP-sensitive assets such as airports, ports, and terminals have been negatively impacted by the coronavirus as a result of lower traffic and volumes from economies shutting down. On the other hand, regulated utilities and contracted assets have been held up well during the crisis, particularly utility companies, which have provided everyday needs to consumers such as heat and electricity. Infrastructure fundraising remains strong despite the global pandemic. However, the total aggregate capital raised in the first quarter did not surpass the fourth quarter of last year, and the number of funds closed fell from 31 in the fourth quarter to 17 in the first quarter of 2020. Traditionally, the most active infrastructure subsectors, energy and transportation, both observed a slowdown in deal activity in the first quarter. However, telecommunications and social infrastructure experienced an increase in deals in comparison to last year. When it comes to assessing the fundamental impact of COVID-19, GDP-sensitive assets such as airports, midstream energy, toll roads, rail, and marine shipping have been more affected, whereas sectors such as cell towers, utilities, and gas distribution have been less affected. Cell towers and other telecommunication assets are experiencing positive secular trends, whereas airports, roads, and terminals are experiencing negative impacts from decreased traffic volumes and economic activity. Overall, infrastructure is expected to be less sensitive to the broader market and economic movements. However, the asset class is not completely protected. Investment managers with primarily contracted and regulated exposures and high-income OECD economies should be better positioned than those with more GDP-sensitive, both volume-based and commodity-linked assets.
Turning to private equity. My name is Derek Schmidt, Marquette's Director of Private Equity, and I'll be reviewing the current market environment. Private equity has historically outperformed other asset classes. While lagged industry returns for 12/31 are still coming in, we can see private equity returns have remained strong over the long term and have rewarded investors with significant outperformance over the last 15 to 20 years. These returns have supported increased allocations within institutional portfolios. While all market pullbacks tend to be unique, we can learn lessons from how private equity has performed throughout the last two significant market pullbacks, looking at both the dot-com crisis as well as the greater financial crisis. In both instances, private equity troughed 3 to 6 months later due to the reporting lag and experienced a less significant trough. Industry returns then improved 1.5 to 2 years quicker in terms of recovery and provided significant outperformance coming out of these periods. From a vintage year perspective, these market pullbacks have provided investors excellent opportunities to allocate to private equity, as the 4 best returning vintages over the last 25 years were in 2000, 2001, 2009, and 2010, during and coming out of these economic downturns. While the future is still unknown and there are reasons for concerns, we do believe it is difficult to market time allocations, and even more difficult within private markets, which is one of the reasons we continue to encourage investors to take an even capital deployment approach. In fact, the data supports the cost of missing strong vintage years impacts a private equity program more than the cost of being invested during the lowest performing vintages. In terms of how the market is currently positioned for this crisis, the industry has never been better capitalized, with over $800 billion in capital awaiting deployment just within U.S. private equity funds. This is due to recent strong fundraising years positioning the industry with record amounts of dry powder. This capital can be used to support current portfolio companies and be deployed into companies coming out of this period as things normalize. However, these market pullbacks typically create a widening valuation spread as uncertainty is priced into transactions and sellers anchor to recent valuations. Over the last 2 downturns, we saw transaction volume slow down for a couple of years, with a 73% decline from the 2000 peak and a 55% decline from the 2007 peak. It is likely 2020 opportunities for deployment will be limited, particularly given travel restrictions. Near term, capital is expected to be called as credit lines are drawn down, but then investors should anticipate a significant slowdown for calls and distributions, as the industry is likely to experience a less active environment for a number of quarters. In the last downturn, industry capital calls declined 55%, with distributions declining 68% from 2007 to 2009. Valuations have been near peak levels, with increasing competition for deployment. Valuations are likely to come down, reflective of public markets, over the next couple quarters, with the middle market valuations likely to be most impacted, coming from a relative high. Initial government programs appear to exclude most private equity and venture-backed businesses from receiving funding due to the affiliation rule, which takes into account ownership structure of the business when accounting for employees. However, each business will evaluate their chances on a case-by-case basis. It seems unlikely at this point that these will be the last two support programs from the government, and the industry awaits further clarification on how future programs will be structured. The qualitative benefit for a small business in having private equity ownership appears greater today than before the crisis, as operators are not alone in navigating this difficult period, with partners that have both capital and resources that can be very helpful to a private business. Recently, Goldman Sachs issued a survey of 1,500 small businesses, and their responses highlighted the current uncertainty small business owners are feeling by highlighting their business's challenges. Many of these challenges private equity firms are particularly well suited to help solve. Each downturn is ultimately very unique, and this one is no different. Looking back over the last couple market cycles, we can see very few trends, which helps to highlight the importance of building a well-diversified private equity portfolio, as well as taking the time to understand the current market environment in terms of which opportunities will be best positioned for success going forward. So what are the private equity takeaways? Don't miss an opportunity. Previous downturns have provided investors with excellent investment opportunities, producing 4 of the best vintage years over the last 25 years. The reporting lag is likely to temporarily spike private equity allocations within portfolios, but these should come down as private equity is correlated to public markets and has historically troughed 3 to 6 months later in past downturns due to this reporting lag. But the industry returns have rebounded 1.5 to 2 years quicker than public markets. Fundraising and deployment are likely to slow down in 2020. But the industry remains well capitalized to support and acquire businesses with significant amounts of dry powder. Private equity valuations are likely to fall from elevated levels in 2020, but the industry is unlikely to see robust transaction volume, as it will take time for business owners to accept these new ranges. And while each economic downturn is unique, and it is still too early to determine how long this will last and how private equity-owned businesses will respond, we believe quality matters, and high-quality private equity firms should continue to prove their value by supporting their businesses and providing them with the additional capital and resources needed to get through this difficult environment.
Turning briefly to private credit, my name is Brett Graffey, alternatives analyst at Marquette Associates. Since the Great Financial Crisis, private credit underwriting standards have weakened significantly. Today, adjustments and add-backs account for approximately 25% of overall EBITDA. Additionally, total debt to EBITDA multiples on middle market deals have reached an all-time high of 6.5 times. The resetting of valuations and deleveraging of balance sheets is a likely outcome of the COVID-19 pandemic will lead to attractive opportunities for private credit managers going forward. In the midst of the Great Financial Crisis, total loan volume dropped off meaningfully. As a result of the crisis and increased bank regulations, banks began to dial back their lending practice and impose higher standards on prospective borrowers. As business began to return to normal, private credit managers filled the void left by banks and have gained substantial market share as a result. Additionally, during the Great Financial Crisis, pricing increased considerably. Post-crisis until now, yields have fallen slightly as LIBOR levels and interest rates have decreased, but private credit yields remain higher than high-yield bonds and syndicated loans. Since the second quarter of 2009, on a rolling one-year basis, private credit has only posted 1 quarter of negative returns, as well as posting 9 straight quarters of double-digit returns from Q2 2009 to Q1 2012, highlighting the strength of the asset class post-crisis and the consistent returns provided to investors during that time. Private credit yields continue to have 250 basis points of premium over high-yield bonds in the broadly syndicated loan market. Strong yields and low correlation should continue to benefit middle market loans, continuing to provide positive differentiation from other fixed income asset classes. Looking at multiple cycles of data going back to 1992, private credit is the best performing asset class in a downturn. We continue to believe private credit allocations will provide investors a defensive allocation shift as the asset class has demonstrated strong downside performance and diversification benefits against other private and public asset classes. Key takeaways. As expected, Q1 was a slow quarter for private credit fundraising, with the asset class only bringing in $15 billion of new capital. That trend is expected to persist through 2020, but the industry remains well capitalized with over $300 billion in dry powder. While opportunities to finance new M&A are likely to be limited, the current market is a target-rich environment for private credit as new opportunities arise from broken deals in the syndicated market and companies looking to refinance their existing debt. Private credit managers are indicating that they're still open for business in this market, but the criteria to get a deal done is higher, as it will take more lender-friendly terms, higher pricing, and more collateral support. We believe that managers who have strong sourcing networks, deep experienced teams, and have exhibited discipline in their underwriting are well positioned coming out of this difficult market environment.
We'd like to thank you for watching this video today. We hope it was a good use of your time and helped you understand a little bit more about the impacts of the coronavirus outbreak on the U.S. economy, capital markets, and also what to look for in the coming months. If you have any questions about the material that was presented in this video, there are a variety of ways in which you can ask questions to the presenters on the call today. If you are a Marquette client, feel free to reach out to your consultant who can either answer your question or put you in touch with the appropriate person from the research team. If you have a specific inquiry, you can email the research team at the email address shown here, research5@marquetteassociates.com. For more general inquiries, perhaps not related to research-specific items, you can email marquettemarketing@marquetteassociates.com. Before we sign off on this video, just a couple of last thoughts. We would love to hear any feedback. We would also like for you to like and share this video as you see fit. Please subscribe to our channel for quarterly Marquette Insights videos. And if you are so moved, register for research email alerts on our website. Last and certainly not least, we'd like to thank you for watching this video today. We hope it was a good use of your time and help you understand a little bit more about the impact of the coronavirus on the economies and markets of the world.